Hi, Cam McLellan here. I'm going to see how people respond, and I like to test my staff and make sure that they're up to speed and have the answers to different methodologies around finance structure. So give us 2 seconds. I just want to bring in someone. Michael, you got 2 secs? Just 2 secs. Sure, mate. Thanks, bud. Video's rolling, mate.
Great.
Yeah.
Hey.
You like that sort of thing? On the spot, can you give people, it's just for this week's blog,
Yeah.
give people an understanding of cross-collateralisation, how to keep your own home safe, and out of the bank's hands.
No worries.
You have 3 minutes, go for it.
All right. Keep it short and sweet. For the blog, in one word, it's about control. Banks love control. They want to structure finance to suit themselves. The way that smart investors need structured finance structured versus the way that banks want to structure finance, about as polar opposite as you can get. Apologies in advance, this is how you've got your finance structured, but here is your own home. And on your own home, you've probably got a mortgage and you've probably got some fantastic equity that you want to utilise, and obviously an income to pay the mortgage and have a lifestyle. When most people look at an investment property, let's say they need to come up with deposit and costs. Let's say it's 10% plus costs. All costs, let's say it's $70,000 for the purpose of the example. What cross-collateralisation is. If you have your own home with ANZ, this is what happened to me, so I'll rag on ANZ. If you've got your own home with ANZ, what most people do is they feel they have a relationship with the bank. They go back to ANZ and say, I found an investment property, will you give me finance for it? What the bank does in that scenario is they will value your own home and not tell you what it's worth. They want to keep the cards close to their chest. They'll do the same over here, but yeah, no worries, Cam, we'll lend you and Felicity the money, provided your own home is security against your investment. Is that a good outcome? It's a great outcome in that you're using equity to move forward. It's a terrible outcome from a risk perspective that should anything happen to this, the easiest way for the bank to get their money is to sell your own house. Rule number 1, separate, build a firewall, different lenders. The way that we do it, go back to ANZ and ask them to establish an equity loan, let's say for $90,000. An equity loan, just a separate loan against the equity to which you're entitled to access based on the equity in an existing asset. We do no more business with ANZ on this transaction. What we do is we simply bring that money over here to cover deposit and costs. We still need to finance the other 90%. Where do we go to get that loan? Talk to your broker. I'm not fussed. X-Bank. As long as it's not ANZ, if anything happened to this, all X-Bank could do is sell your investment property, you've still got your own home. There's the structure that we use to keep finance separate, keep each individual property structurally separate, and give you the flexibility to duplicate when you want and when you can. One last point, you'll probably notice we only need 70,000 over here, but we took 90,000 over here. Cash flow 101, guys, buffers. If anything happens, if you lose your job, if your kids get sick, if you need school fees or whatever, it's a lot better having it than not. Keep 20,000 sitting there in this equity loan. You only pay interest on what you spend. So whether you take 90 or 100 or 110, if you only use 70, you only pay interest on 70. The rest is just your insurance policy against your cash flow. Finance 101, avoid cross-collateralisation, keep your structures separate, and you'll be able to duplicate a portfolio when you want and when you can.
Thanks, mate. I'll give you something a bit tougher next time.